In the last 14 days, central banks from the EU, US, Japan, and China have announced stimulus or QE plans for a plethora of reasons. Some reasons for the stimulus are to devalue currencies relative to other currencies to gain an export advantage, to try and cover burgeoning government budget deficits, so direct taxes do not have to be raised on citizens, so government spending does not have to be drastically cut immediately, and finally, to try and stimulate job growth the only way Keynesian central bankers know how. There were literally thousands of experts on CNBC and Bloomberg since QE2 expired and for all of 2012, up until the Fed's big announcement, saying there would never be another stimulus or quantitative easing announcement from the Federal Reserve again. Are we going to get an apology, a mea culpa, some crow to eat, or a slice of humble pie from these talking heads admitting they were completely wrong? I doubt it, but I would respect these people a lot more if they admitted they make mistakes, even as professionals are still indeed human and still make mistakes. Unfortunately, I think almost all of them will go on talking like what they said wrong never happened. As investors, it's our job to find the people with the best track records, whose opinion deserves credibility, and our trust, whether we manage all of our own capital or we find someone else to manage it for us. These people have had a poor track record on the markets, on their macro calls, and I can make a good argument many don't understand the macroeconomic situation we currently find ourselves in that I've spent the last 5 or so years literally studying every day to comprehend at the levels I currently understand them. But because these people just happen to be on CNBC all the time, many people automatically trust their opinion as an expert on everything. These same experts are on TV telling you not to buy gold or silver, and if you do, only to buy GLD or the SLV instead of physical bullion or quality, cash flow, royalty streaming companies, or profitable gold and silver miners, when many know nothing about precious metals whatsoever or have missed the most powerful fundamental trend going on in the world for over a decade. Right now, many experts are on TV telling people not to buy mining stocks. If you bought gold and silver miners or mining indices a few months ago when sentiment was extremely negative for the companies despite solid earnings increases, you have made 40% or more on some of your stock positions already if you're smart enough to have cash or a liquidity position on the sidelines to buy the panic like I said in previous GoldSeek Radio commentaries months ago. Even juniors are starting to move up a bit considering many still have serious financing issues to overcome in the future. Being an astute and well-researched follower of markets, I see many experts on mainstream financial media saying that bullion's paper prices will outperform mining stocks on a percentage basis over the next 18 months. I could not disagree more. The hedge fund spread trade of long bullion on short miners is not a permanently profitable trade as many hedge fund managers and Wall Street talking heads believe it to be. I think some gold and silver shares could outperform bullion on a percentage basis by many multiples depending on the earnings growth for producers and other fundamentals of the company over the next 18 months. I also expect to see more producers implement dividends for the first time or start increasing dividends as gold starts to make another run towards 2000 in the upcoming months. After a big run-up from 2010 through part of 2011, producing hundreds of % returns in many gold and silver shares, miners violently corrected downward and then consolidated for nearly a year. Many retail investors threw in the towel sometime in the last few months, vowing never to own another gold or silver stock, and instead just buy physical bullion, having chased mining stock prices higher instead of taking gains when stock prices went up hundreds of %, and keeping some cash or bullion handy as liquidity to buy shares after they corrected, waiting for the next up move, like what I think is coming over the next soon over the next few months. I think the odds are high that this correction and consolidation period is now very close to over. Other experts in the precious metal sector, with long track records of doing well investing in the sector, like David Morgan of the Morgan Report and Silver-Investor, agree with me that the miners have put in a bottom because there is now basically a permanent price floor for gold, silver, and oil's rising costs of production due to increasing input costs, largely which are in thanks to central banks devaluing fiat currencies. In conclusion, the Fed and other central bankers are back to repeating many mistakes Keynesian central bankers also made in the 20s and 30s, but this time currencies will be devalued massively more to monetize debt and allow spendthrift Western governments the privilege to not drastically cut back on spending. Unfortunately, this time the fundamentals of the U.S.'s economy are nowhere near as strong, and the U.S. dollar's purchasing power will be the main victim, far worse than it was in 1933, after FDR closed the banks on a bank holiday and devalued the U.S. dollar by 40% against gold. With these recent QE stimulus announcements from the Fed and other key players in the world economy, all wanting to devalue their currencies, we are going to see more and more intervention into capital markets and the real economy as Keynesian interventionism increases, trying to manage us through this crisis and keep the markets and our real economy in what I call a managed, low-level stagflation sweet spot. Will they succeed? Financial history says this attempted controlled stagflation via money printing, financial repression, and the wealth effect will be unsuccessful, but the entire world has never before been exposed to a completely 100% paper fiat currency system. I think stagflation is guaranteed at best and will worsen a number of degrees. This is not doom and gloom, just reality based on what I see the facts of the world are. There will be a number of people who, with the real facts of the economy, make multi-generational wealth in this wealth transfer ahead. For more information on my views of the economy and the markets, check out the main Wall Street for Main Street website at WALLSTFORMAINST.com or follow me on Twitter at Jason, E as in Elliot, and my last name Burack.